So today we're going to walk through some US market peripheral notes from March 27th, 2026. And wow, they really paint a picture of a market that is just teetering on the edge. Let's get into it.
Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
This video presents a direct informational narration of the source document. Okay, so here's our game plan. First up, we're going to look at the core signals, basically what kicked this whole thing off. Then we'll get into the trend interpretation, what the charts are telling us about this technical breakdown. After that, we'll talk action items, how to actually navigate this mess. We'll also cover market commentary to see how different assets are reacting, and then really dig into why tech is getting hit so hard. And to finish it all off, we'll look at the outlook and what the path forward might look like.
All right, let's start with Section 1, Core Signals and the Geopolitical Shock. You know, the market's equilibrium? Well, it's been completely broken. We're talking about an extreme geopolitical premium that has just thrown everything off balance. The entire conversation has flipped. It's no longer just about inflation. People are now genuinely scared of a systemic survival crisis.
So you're probably asking, what exactly triggered this panic? Well, it was a rapid-fire sequence of three major events. First, you had the US and Israel conducting precision strikes on Iranian nuclear and steel facilities. Right after that, Iran's IRGC responded by announcing they were closing the Strait of Hormuz, which is, a massive deal. And to top it all off, a G7 meeting revealed that the US administration itself was fractured on the conflict timeline, which just poured gasoline on the fire of uncertainty.
And this quote really nails the core issue. You've got the Trump administration's maximum pressure approach smashing right into the IRGC's radical wartime model. The takeaway here is pretty stark. This setup is enough to keep the global supply chain under a massive risk premium for a long, long time. And what that means for investors is that discount rates for global equities are just going to stay elevated.
Okay, moving on to our second section, trend interpretation, the technical breakdown. Look, when a market breaks its long-term moving averages, it's not just a small thing. It signals a major consensus trend reversal. This is when the stop-loss selling really takes over and things can get ugly fast.
And here you can see just how brutal the selling was. The S&P 500 down more than 2% for the week. That's 5 straight weeks of losses. And the Nasdaq Composite got hit even harder, dropping over 2% on Friday alone for a weekly loss of over 3%. But here's the real kicker. Both of them closed right at their intraday lows. That's a sign of just absolute weakness. Now let's zoom in on some key levels, because these numbers tell a story. The S&P 500 has decisively broken below 6,400. And you have to understand, that's not just a number. It's a huge psychological threshold. When a big round number like that gives way, it often unleashes a whole new wave of selling. The selling got so bad that we even saw an intraday low of 6,356. Now, why does that number matter? Because it's a spot with a huge concentration of institutional put hedging. Think of it as a defensive wall. If that wall breaks, those same institutions might be forced to sell stocks to rehedge, and that could just pour fuel on the fire. So, where's the next line of defense? Well, we have to look all the way down to 6,176. This is a really meaningful level because it lines up with the 2024 high. It's that classic old resistance becomes new support idea. If we can't hold there, well, that's a very bad sign. Which brings us to Section 3, Action Items. How on earth do you navigate this crisis? Honestly, with so much liquidity risk and policy risk, especially that weekend gap risk, position management and avoiding that risk are now prerequisites. Survival is the name of the game. So here are the 3 key pieces of operating guidance right now. Number 1, avoid bottom fishing as long as the market is below 6,570. Just don't do it. Number 2, you absolutely have to assess that weekend risk. Headlines can change everything in an instant. And number 3, keep an eye out for a potential sell the news event. Sometimes when the feared event actually happens, the market has already priced it in and you might see a surprise reversal. All right, Section 4, Market Commentary and Asset Reactions. That straight blockade premium we talked about, it's causing a second hit to global inflation expectations, mainly through rising energy costs. This is just rippling through everything. And here's a big one. Crude oil has hit $100 a barrel. That's a huge number because it officially puts us in the administration's economic warning zone. Naturally, we saw the VIX, the market's so-called fear gauge, spike to an intraday high of 31.
And yeah, that's high. But here's the thing. To get a true, emotional, everyone gives up kind of bottom, you usually need to see the VIX hit that 35 to 40 range. So we might not be at peak panic just yet. And this quote highlights a really scary potential second-order effect. Think about the big sovereign wealth funds in the Gulf. Their cash flow from oil gets cut off by this blockade, so what happens? Well, as this points out, they might be forced to raise cash by selling U.S. equities, and that could create a whole second wave of pressure on a market that's already incredibly fragile. Okay, let's dive into Section 5 and analyze what's happening to tech, because it's getting absolutely hammered. We're seeing deep structural damage in mega-cap tech stocks, and it's coming from a threefold pressure set: legal risk, debunked AI narratives, and just a general capital flight to safety. I mean, look at this. The Magnificent 7 index has pulled back 19% from its high. That is deep into correction territory. We're seeing classic signs of long liquidation, where the selling just begets more selling. And it's not just the algorithms. This quote, attributed to Cathie Wood, points to liquidation-style selling across a whole host of big names: Meta, NVIDIA, AMD, TSMC, you name it. When you see a major institutional player like that selling off positions, it signals a really deep valuation reset is underway in the tech sector. And the damage to individual stocks is just wow. Tesla's below its 365 support, down 27%. Meta has seen 12 consecutive down days. But maybe the most worrying sign is United Health, which is supposed to be a defensive name, also breaking down. When the defensive plays stop working, you know there's nowhere to hide. So, all of this leads us to our final section, the outlook and the path forward. The bottom line is this: while we are absolutely in an extreme fear zone, the market probably has not reached that final stage of capitulation yet. So what happens from here? Well, there are basically two scenarios on the table. The base case is an S&P retest of the 6,100 to 6,200 range, which would be about a 12% drawdown. But then there's the bear case. If the Strait of Hormuz situation doesn't get resolved, we could be looking at a test of 5,500 to 5,600, and that would mean a prolonged bear market. And that brings us to the final and maybe most important number in this entire analysis: 6,570. That's the 10-day moving average. It's really the only technical yardstick that matters right now. Until the market can get back above that level, it can't return to anything resembling a normal regime. The takeaway is simple: the bulls are not in control.